I think it's critical to understand that the macro environment we're in. The credit bubbles in emerging markets in general tend to lead to a devaluation of currencies. About 60% of the yield curve in the US today is inverted. Gold is going to have its another wave to the upside.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or have not already done so, please do subscribe to the channel, click on the bell to be notified on new updates, and do give us a thumbs up if you like what we do. We appreciate your support. Our guest today is Otavio Costa, Global Macro Analyst at Crescat Capital, an asset management company that capitalizes on the most compelling macro themes to grow and protect wealth. His research has been frequently featured in financial publications such as Bloomberg and the Wall Street Journal, and we are delighted to have Otavio here today as a first-time guest. Good day, Otavio, and welcome to SBTV. How are you doing?
I'm great. How are you, Patrick?
I'm doing fine. Just going to try and hang in there with you today. I know you're one of the really bright guys, so I'm going to try my best to hang in with you.
I don't know about that, but thank you very much for having me. I look forward to talking to you.
Same. Otavio, can we just simply start by with you sharing with us your background and also the work you do with Crescat Capital?
Sure. So I'm actually from Brazil, moved here to the U.S. Right in the midst of the whole financial crisis in '08, initially to play tennis in college and so forth. And started working for Kevin later on after college. And I mostly focus on the global macro research and help him to manage the portfolio in general. In Crescat, we really develop macro models in general, and they're very systematic models that help us to come up with or develop themes in general. Right now, we have three major themes in a portfolio, which is long precious metals, and we think China is the largest credit bubble in history, and U.S. being the largest, also a big historic bubble as well. But my work here at Crescat has always been, in the beginning, was more related to emerging markets, and then I kind of graduated from that. Now I'm more focused on global macro and really multi-class kind of research, and really enjoy talking about that topic as well.
I note that Crescat Capital's proprietary models, which you help to build, are built on value and behavioral investment principles. Can you explain what is meant by value and behavioral investment principles?
Sure. So a few things. The first, there's one model that we use to that ranks about 2,000 stocks in the world, the most liquid stocks, and we use that as a way of, let's say, if we think that banks are going to do well, we search for the best banks that we can find in that model and so forth, and we also search for the best investments in each country, and the same way goes to the short side as well. Now, what we took to another level more recently is really trying to build more macro related, which relates to the topic you just said about behavior measurements in the markets, and one of them was the what we call the Crescat's macro model, which is actually a fairly simple model, but it's looking at 16 factors and includes macro and fundamental and some other technical indicators. The idea here is to, I've said this before, but it's to acknowledge that not a single factor works throughout history, but when you combine many factors, you can at least have an edge on figuring out where you are in the business cycle. So in our view, this model right now is somewhere close to 2 percentage points away from historical levels, and it goes back all the way to the 80s, which gives us a conviction that we are, very late in the business cycle here. And so in our view, when you aggregate that with other research and other macro signs that we're seeing, it gives us enough conviction to believe that we're getting close to what we think it's sort of an overdue recession in equity markets in the U.S.
Okay, so late in the cycle, I've read that we are still in the midst of the longest economic expansion in U.S. history here. I think we're at about 120 months or so. Mm-hmm. Many people believe that this expansion is artificial. and made possible mainly with the creation of credit by the Fed. What's your view on the US economy? And I know you touched on it a bit. And how long more will this economic expansion last?
Well, that's the $1 trillion question, no doubt. But my best take on that is to use those macro signs of being alluding to, right? So first of all, we start looking at credit markets more in depth. We saw that all the signs, and initially it was, well, let's look at the yield curve in the U.S. Yield curve as being sort of a very reliable way of predicting recessions and serving as a bellwether for stocks and the economy. And what we found is that if you instead of looking at single spreads in the yield curve, let's look at the entire yield curve. So we're looking at all 44 possible spreads in the yield curve, and there you can find that about 60% of the yield curve in the U.S. today is inverted. And that's including the inversions between 30-year yields all the way to 10-year yields to overnight rates, which is the Fed funds rate. And that's just as high as it was at the peak of the housing and the tech bust, and which is well above moments like the 2016 times when we had this this change in the Fed stance from a more tightening cycle to more dovish and kind of pausing its rate hike cycle that we were at the time. That kind of extended the business cycle, but at that time, the yield curve inversions was not even close to the levels that we have today. So I think that's one major part of our thesis. The other thing you can see about this kind of prop up by central banks sort of bubble globally is looking at the 30-year yields, which is another major chart that we put out that is, I think it's critical to understand the macro environment we're in, which is about 16 economies today have their 30-year yields lower than LIBOR rates or the Fed funds rate as well, which tends to happen every time at the peak of a cycle. We put out this chart that goes back all the way to the 90s or so, and it's really interesting. I mean, it's those type of inversions, they're very telling. They usually are at the peak of a cycle, but it also tells you that you have what we call the global yield curve inversion, which is essentially negative for stocks. And at the same time, even though we're very long precious metals, we also believe in the dollar as being the cleanest dirty shirt out there. And in terms of, especially against places like, the Chinese yuan and the Hong Kong dollar and so forth. So we're long the dollar against those currencies. And the belief here is that maybe, U.S. rates are a little bit too high relative to the rest of the world. And if there is a flow towards treasuries or so, which we've been seeing recently, we would expect also a flow towards the dollar. So that's kind of our thesis behind that as well. But certainly the global yield curve inversion is the big part of it. And then you can see other things like sentiment in general, or just confidence. Consumer confidence tends to be at its peak every time you are at the peak of a cycle as well. It tends to be a contrarian indicator, and we're seeing that at being at very high levels, even though now it just started to tick lower. Another thing we put out as well is this divergence between the sentiment from Michigan sentiment of consumers versus consumer confidence, which that spread is also starting to show every time the spread diverges, it starts to, you are also at the peak of a cycle. And that what tends to lead in that way is actually consumer confidence that begins to drop first. And then that kind of leads the whole, this indicator to start flashing warning signals out there. So, there are really over 50 factors that we're looking at that gives us the conviction of this. But those are a few ones that I think they're important to mention. Not to forget about some very important moves that we're seeing today, like the copper. Look at copper prices today. If you look at copper all the way back to, I believe it's September or August of 2017 to today, if you look at copper versus S&P 500, there's a divergence of close to 35% or so between the two. That's very extreme. The last time we were at that peak, we were in September of 2018, which was right at the peak of the market, peak of the market as well. So that gives us a conviction as well that there are some cracks in the internals of the market, especially copper. You can see Russell 2000 beginning to diverge from the S&P significantly. You can see the 2-year yields that, we can dive into that. There's also another thing that when it starts to drop significantly, you're also, usually at the peak of a cycle as well. So all those signs are really flashing red to us, and we're starting to take a very defensive stance here and starting to short stocks quite a lot.
Okay. Typically, yield inversions they do indicate a recession on the way. How long of a runway do you see before we actually start to feel the recession's effects?
That's a tricky question because there's quite a lot of you had a few of them like '08 that took another 1 or 2 years on the 2 versus 10s. Now you have 2000 period when the inversions, or the percentage of inversions, any way you look at, happen precisely at the time of the peak of the market. So, and go back further, you see, multiple times when it happens at the time of the peak of the market or a little bit before that. So it's hard to tell, but there's one indicator that I thought was very good from Professor Harvard Campbell, a finance professor from Duke, and he put out this research looking at the 5-year yield versus 3-month yields, and every time that inverts for over a 90-day period, a full quarter, that tends to lead to a recession in the next 12 to 18 months. And we're now at about 110 or so days of those two yields inverted, which it's another way of looking at inversions and how we're likely to see this crisis playing out soon.
Okay, so do you think we're on the precipice of a major correction similar to what we saw back in 2008?
Absolutely, especially when you looked at valuations of private and public markets in general. They look very overvalued. We put out this table looking at the different factors, fundamental factors of the public market, especially stock market here in the U.S., which shows that about it's essentially a record overvalue in 5 indicators. Another 3 is very close. It's many ways of looking at enterprise value relative to other fundamentals of from sales to free cash flow to EBITDA and so forth. And the same doing with market cap. And it's quite interesting. You have the CAPE ratios showing the problem. And CAPE ratio is an interesting one because you have to adjust. John Hussman does a great job at analyzing the CAPE ratio and adjusting for margins, because margins tend to be great when you're at the peak of a cycle. And so adjusting for margins or CAPE ratios of today are really at all-time highs. So there are several ways. A PE ratio, it's such a misleading indicator that everyone tends to really rely on it. And I think that, when you look at PE ratio, essentially, it tends to be low, at the peak of a cycle, because earnings tends to be very good at the peak of a cycle. So, and actually, if you look at, not even that argument is correct, because if you look at PE ratio, let's just look at the Schiller data. So you can get which is it's a GAAP earnings. It's using GAAP earnings to calculate PE ratio. And you can back all the way to the 1800s. And if you look back to all those times, today we have the second largest PE ratio relative to other peak of bubbles that we've had in history. And it's really extreme, even on the PE ratio basis. When you put that, the other argument of more of a bullish argument is, okay, PE ratios are high. I agree with that, but interest rates are too low. Well, you can chart, just plot 10-year yields versus the PE ratio. And you can see as well that we're, certainly at an outlier right now on the plot of valuations relative to interest rates as well. So, now what you need is that valuations in its own that doesn't really give you any timing indication. But when you start looking at the credit markets and the yield curve inversions and sentiment and labor markets in general, you start seeing some cracks in the economy that maybe we're getting really close here to an inflection point for global stocks in general.
Yeah, touching on those bubbles. We hear the word all the time, everything bubble, to describe where we are today and why so many assets are in this bubble territory. Can you help us understand where this everything bubble exists? I know you said globally, so it's not only the U.S. I know you mentioned China, and we're looking at Europe as well.
Yep. So I think at the center of the problem, everything really started being driven by China in terms of, if you look at global growth, over about 50 to 60% of global growth came from China since the global financial crisis. And China really is the largest banking system we've ever had in history. And, in relative to GDP terms and absolute terms as well. It's a 40 trillion on balance sheet banking system on top of another 45 trillion of off balance sheet assets. And, when you include that relative to GDP, it's really unprecedented. It's larger than it was at the housing bubble in '07, also higher than the European debt crisis and any other crisis we've had in the past. So, that part of it for us is where, the outflows of China, we think that this credit bubble that was created throughout the years in China has really been, what's going to happen is that we're likely to see a devaluation of the yuan. We've seen throughout history that credit markets and bubbles or credit bubbles in emerging markets in general tend to lead to a devaluation of currencies and crashes of equity markets. But most importantly, what we see is that gold in local currency terms tends to rise. So we're very long gold in renminbi terms. So that's one part of it. So understanding China, that is, is a credit imbalance. And when you have that, we show many signs of China, of capital outflows, especially from the elites of China coming out of China. And that money tends to go to places like Australia and Canada's housing market. And as we've seen, this kind of exacerbating this distortions in the prices of houses in those places. And those are two housing bubbles as well. And you can look at the banking system of those two countries, and they're also very bubbly. The valuation of those look very much like the valuations of the banks here in 2007 at the housing bubble. So there are a lot of issues that we're looking at the markets. Hong Kong is another one, but it's linked to China. So if you put that all in kind of in the same bucket, so you have China and Hong Kong, and then those are kind of derivatives of that would be Australia and Canada, and the U.S. on its own has been, kind of prop up through, either through money printing and just extreme easy monetary policies that kind of cause the same issue with asset bubbles everywhere that we're seeing. So that puts us in a very a bullish camp in terms of precious metals. As we think that's ultimately what's going to be the real form of safe haven here.
Okay, so fair to say, well, with all that you just said, we're looking at something worse coming down the road than what we saw in 2008.
It's hard to say because I think it's going to be, first of all, if we're going to get to let's say we're going to get back to medium levels of stock market. Everyone loves to talk about stock market. Yeah. So let's say if we're going to get back to valuations, back to medium levels, we got to go down at least 40% or so from where we are today. So, but markets work like a pendulum, and it never stops in the middle. It tends to swing farther than the middle. So you would expect it would decline further than 40%, as we've seen throughout history. That's what it tends to happen. So I think that it's fair to say that at least a 40% decline is what we expect, at least from the S&P 500 here, from its peak, which is now. I think that's the major part of how we see this playing out. But it's the other part of it that it's important to is what we hear a lot is, well, what if we're in a different world where central banks are able to really prop up the markets through money printing and negative interest rates and so forth. Well, that's why we're very bullish on gold. Essentially, the best trade that we can find right now is really being long gold and selling S&P 500, the gold to S&P 500 ratio. And there's so many ways you can look at that ratio. Why, if you look back in history, it resembles many times where this ratio was in the very early stages of a big move here. So we think we're very bullish on that ratio as this whole thesis will tend to, is likely to manifest itself here.
Okay. For viewers that may be new, you're looking at going long gold. How does going long gold help in this type of crisis?
We did a whole study on percentage of inversions, right? So the inversions in the credit markets and how to really implement that as a trade in your portfolio, and figure out that the best way really is to be long gold and sell U.S. stocks. We don't know. Sometimes, like you said, sometimes it takes another 1 or 2 years for stocks to really peak, but during that period, precious metals tends to start working, which is exactly what we're seeing today. That ratio, broke out from a multi-year downward trend, and it's, and kind of retested that line again. And it broke out in December with authority, and then it kind of retested that in April. And it's, it's now, it's starting to rise again. And, I think that's the key part of it. But there's so many, you looked at all these issues in the markets, right, that I was just discussing about. And then when you look at things like implied volatility for silver, which is a high beta version of gold, would be, it's essentially all-time lows. It's so that doesn't jive. That doesn't really reconcile with this whole thesis. So that's why we're very bullish on that. There's also, you can look at gold relative to, or silver again, relative to, kind of the broad stocks like Russell 3000 ratio. So let's look at Russell 3000 relative to silver. And that ratio just retested the levels of 2000 on the tech bubble, those insane valuations we had in the past, just retested that, kind of forming a double top, and it's now starting to decline. So, these are all signs of how absurd the valuations of equity markets have reached. Another way to look at that is looking at commodities in general, the commodities versus equity, U.S. equity markets kind of ratio. And you can see that it's actually in a fresh 50-year low right now, which, it's another way to look at that and see how, if you look throughout history, it tends to be very cyclical. And, right now it's well below its median going back to the 1900s. And, we think that it's even lower than levels of the Great Depression in the 1929 preceding the 1929 crash. So, that just gives us another conviction in why commodities, especially precious metals, look very attractive relative to U.S. stocks.
Okay. Would you say we're beginning a bull market, or have we been in a bull market for gold, or is one starting to come up?
I think this is the very beginning of a bull market for gold. And what's exciting about it is that when you start looking at ways of implementing a trade, you can look at, obviously mining stocks is the first thing that comes in your mind. And you can see a lot of companies are still trading at, they're in a bear market for since 2011 or so. And some of them are down 70, 80% from those levels. And what's interesting about that is that, when you looked at their EV or their enterprise value relative to things like, reserves, or precious metals reserves in general that they hold, some of those are trading at like 2 times reserves and their reserves. And it's, we're looking at very depressed levels of gold and silver. If those things go higher, you would expect some of those guys could be even trading at below 1. On that ratio. So, we're very, very bullish on some of the mining companies, and we think there's going to be a lot of it's likely to see a lot of consolidation in the whole industry as there are a lot of wonderful assets out there. They're likely to be in a bidding war of this whole market. So we're very bullish on mining stocks in general. You can see mining stocks as well. I love doing ratios. One way is to look at just the S&P 500 mining index, the precious metals index, relative to S&P 500. What you can see there is that actually the peak of the index was, so S&P 500 relative to mining index. You can see that the peak of that market was actually in 2015. In 2015, some of those stocks from 2015 to like mid 2016 or 8 months or so during that period, some of those stocks are up like 400% during the time. Silver mining stocks and gold mining stocks. We're seeing a very similar opportunity today, but now we're seeing really the Federal Reserve taking an even more dovish stance that we saw in 2015, 2016 at the face of all this, record overvalue of stocks and also private markets as well. So, when you look at allocations of precious metals among pension funds being, really record lows. Millennials, I'm a millennial, and I don't hear any millennial talking about precious metals. There will be a point that gold is going to have its another wave to the upside. And I think we're in the very, very early stages of that. And I've said this before, I think that it's very possible we could even see a parabolic move on gold here in the following years. And I think we're in the very, beginning of that.
Okay. You're pretty much an expert in the markets. You dissect it very, very well. I'm curious though, was there any one or two or three things that gave gold this most recent bump, this recent push? Were there any one, two, or three things that you saw?
I think the biggest one that we saw was obviously the real decline of implied vol reaching an extreme low level in both in gold and silver. There was also the silver to gold ratio being at ridiculously low levels as well. A lot of things just kind of bottom, and the market was just looking extremely toppy, and it's been a while now. We're seeing the percentage of inversions, if you looked at throughout this whole year, which I think that's key for gold. I think that understanding credit markets and linking that back to precious metals is absolutely key and critical to allocation of portfolios, and especially in precious metals. And we saw this percentage spiking, and since March or so. And this is, even though markets are going higher, look at 2-year yields. The 2-year yields for me was a big one, because you can look at 2-year yields all the way back to the 1970s. And it's a very simple chart. It should be a must watch in everyone's list of macro signs. And if you look at 2-year yields in a log version, and you just connect the tops and form this resistance line, multi-decade resistance line, every time you touch that line and it starts to fall significantly, we tend to be at the peak of a cycle. And as well, it's mostly driven by credit markets kind of pricing in that the Fed is going to start easing significantly. Yeah. And when you have that ahead of the valuations that we have, I've never seen it throughout history that we're not at the peak of a market. So again, that was seeing the S&P 500 going straight up, and then 2-year yields going straight down. That for us was like, we got to take a stance at least on precious metals. So we've been very vocal on this bullish position more recently.
Okay, you mentioned gold possibly going parabolic. How does silver figure into that parabolic move from gold?
Oh, silver looks, in a great position here. We have obviously, got to remember that on this way up, that I think it's going to be a way up. There will be a lot of short-term selling, and it's kind of what we see now. We saw gold and silver and gold mining stocks reaching, if you look at technicals like RSI, 14-day RSI, just a very short-term kind of move. It definitely reached a historical level. In other words, they had a very extreme move in such a short period of time. But the idea here is that we think silver below $20 an ounce is just absurd. I mean, we're likely to see that going way higher than where it is today, and we're very bullish on silver, especially on silver mining stocks. That also, what I was alluding to, a lot of those companies that have trading at 2 times their reserves. I mean, a lot of them are actually silver companies, and or have a larger percentage of precious metals and silver. And we're very focused on those companies because we think that those have a ton of opportunity in the following months or so.
Okay, and so this would be what I think you've been calling the trade of the century, where we may be looking at selling stocks for gold?
So the trade of the century relates back to China, and that idea of, if there is a credit bust in emerging markets, what you tend to see is gold in local currency terms to rise. Yeah. And what's interesting now, we're seeing this whole political turmoil in Hong Kong. It's really China too. And I don't know any time in history that we've had such a significant turmoil or political unrest and social unrest that doesn't lead to a sell-off in equity markets or currencies. So, we've had that in Brazil. I'm from Brazil, and I saw, this a huge devaluation of the real in 2014 with impeachment of Dilma, and we also had that in Argentina. We had that in Turkey. We had that in 1997 in Hong Kong. It wasn't the currency that suffered. It was the equity markets. They're down close to 50 to 60% at the time from peak through trough. So, and we had also in China in the early 90s, the whole social unrest, Tiananmen Square and so forth. That whole thing was also, very bearish for the currency. The currency devalued significantly during that period. It was also a bearish moment for the equity market in China in some of those periods. So, we're looking at that when we think that really gold in renminbi terms is at the very early stages of a bigger move. And you can see that gold in renminbi terms has been pegged essentially for the last 3 years. And it's now just starting to break out from this kind of a pegged line. And if you look back and look at that ratio of gold in renminbi terms relative to global stocks, just the MSCI World total return, going back to history all the way to the early 90s and 80s, what you find there is that, that ratio tends to rise every time there is a turmoil globally. So either global financial crisis, tech bust that was not even related to China, but China got impacted by that. But also it tends to rise when there is a local problem in terms of a more domestic issue, like we had in the early 90s or so. Especially one I like to talk about is 1993, when China devalued its currency on one day by over 30%. And we're not calling exactly for a one-day devaluation in the following years, in the following months or so here for China. But what we're seeing here is that, we're very likely to see a significant devaluation of 20-30% or so on the Chinese renminbi, and then and likely to see the gold prices rising at the same token. So that's really the macro trade of the century, and I think it started to play out back in the fourth quarter of 2018. About the medium stock in China was down close to 40%, and during that period, I don't know any economy in the past that had such a depressed levels of stock prices in general, and wasn't in a recession. We're starting to see some real signs of the economy and of the Chinese economy starting to crack down. Where now we're seeing if you look at the LIBOR versus SHIBOR rates, which is one way of looking at the divergence of monetary policies between the Fed and the PBOC, and you can see that that's at the highest level since 2007, since the global financial crisis. And if you look and compare that rate differential with the exchange rate of the currency, the currency was trading at the time at about like 7 USD-CNY. It was about 7.3, 7.25 depending on the time. I mean, today we're below 7, and it's, we think it's the Chinese currency is just absurdly overvalued, given all this macro imbalances in the country. This macro trade of the year is perhaps 80% of our portfolio today or so. It for three things need to play out, I guess, but they don't all have to play out at the same time. But if one of them play out in a big way, let's say global stocks get really in a recession, I think that ratio is going to rise regardless. Or precious metals rising significantly here. I think that could also be a huge opportunity, a huge driver, which has been the case in the last since April or so. Precious metals have been really driving that ratio now. And now we've seen kind of this Chinese currency. Look at the implied vol for the Chinese currency today for the next 12 months is like a 3-year low. So the entry point of shorting that is if you believe in the same, if you agree with the macro imbalances as stated here. I think it's fairly attractive. And there are other ones too. I mean, I think that the risk reward of shorting stocks today it looks phenomenal, as given again how we are in terms of the peak of the cycle, and also given the valuations that we have.
Probably more so now than ever. There have been more and more calls by leaders of state to reduce dependence on the U.S. dollar. No surprise here. It's China, it's Russia, Iranian leaders who have been saying that. But we're also seeing Europe now. European leaders like Jean-Claude Juncker publicly saying that it is absurd for Europe to pay so much of its trade with the U.S. dollar, and there certainly has been increased displeasure with how the dollar has been used in some ways as a weapon. Is the issue of de-dollarization a macro trend that you are keeping an eye on, and what do you make of it?
I think the de-dollarization is a real trend, even though I don't see what's the alternative for it besides gold. But I don't also think we're going to go back to the gold standards right now. I think that I believe in the gold bug mentality, and I'm a firm believer of that. The same way I'm a firm believer that we're going to see interest rates higher in the U.S. and the long end of the curve. Now, the question is timing, right? When is that going to manifest itself? I mean, I don't know if it's going to happen in the next 1 or 2 to 3 years. So I think that in terms of looking, especially when you're managing a portfolio, that's the way you should look at. And for now, I don't see an alternative. What's the alternative? The euro? I don't think so. The British pound? I don't think so. The Japanese yen? I don't think so. The Chinese yuan? No way. I really think the Chinese yuan has there's no competition with the dollar here, with the Chinese yuan. So the real question is which one? The Canadian dollar? That's such it's a small relative to other places. So given the still the especially political strength of the U.S. versus, I'm going to be very specific, versus other places, I think it's still the strongest currency we can find. And imbalances in the U.S. are big, especially in the stock market and credit markets, corporate credits and so forth. But so they are also in places like Europe and Japan. The amount of leverage in the Japanese financial system is insane. And same with China. I think we've heard a few days ago somebody making a joke. It's easier to see people start buying oil in Saudi Riyal terms and buying in Chinese yuan, and I totally agree with that. Because who wants to buy Chinese renminbi right now? If there was any significant demand for the Chinese currency, would have seen some sort of move towards that. But instead, we're seeing the opposite. Instead, we're seeing the PBOC being very reactive in terms of trying to prop up the currency and not allow the currency to completely fall apart. That's really what we're seeing today. So, anyways, and it's kind of interesting, especially when you look at the divergence of monetary policies is happening across the entire globe, and the interest rates that the U.S. is, even though it's likely to drop interest rates soon, where interest rates are today, it's extremely high relative to other places. The Hong Kong Monetary Authority cannot keep up with the same interest rate, even though they are pegged with the dollar. Same with China. Shibor rates are not being. That's why you're seeing those divergences of Shibor versus LIBOR rates and so forth. And that's I think that's all a big problem. So I'm not seeing the de-dollarization is definitely a theme to be researching and be on top of it. But I don't think it's really a theme for the following 6 to 12 months. I think that's I'm a believer of gold much more because of the macro imbalances and because of the timing of how things are likely to unfold. And if I believe that, if you look back since 2000, every crash central banks have been printing or doing even more extreme policies, and I think we're going to see another one of those. And and this time I think gold is really going to take off. And inflation would be just a cherry on top of the whole thing. Eventually, we're going to see inflation. People are just ludicrous to believe we're not going to see inflation. We will. We're not seeing it. Some of the data, some others we see. In terms of like healthcare costs. Obviously, you're seeing how prices rising, but I don't think that that's necessarily true in the overall economy yet. But at some point we will, and that's going to be the cherry on top of the whole precious metals theme, I think.
Before we go, can you let our listeners know more about your work over at Crescat Capital and how they can find what you do? Because I know you have a lot of charts there, right?
Yeah, so I try to be very, very active on Twitter. I try to, if you go to my Twitter account, I as I said, I have the three themes that we believe here: the China credit bubble, the U.S. being a historic bubble in the stock market, and also precious metals. I try to tackle all those topics and on a daily basis with charts, macro charts, and now I'm doing also macro outlook presentations on YouTube as well. You can just search for Otavio Costa on YouTube and you'll find my presentations. I just try to kind of aggregate some of the charts that I thought were interesting. I try to do a very independent type of research. And I know that that's kind of a crowded thing to say out there, but you can just scroll down on my feed on at Otavio Costa on Twitter, and you'll see that's I think the type of work that I do and Kevin Smith does as well is very unique and different from other shops. But anyways, I think that those are the best ways of finding my work, and I'll continue to be very active, hopefully, and to be very vocal about my opinions.
Okay, Otavio Costa, we appreciate it. I'm sure a lot of people are going to look you up and start following you on Twitter, as I do, which was how I found you. Your work it's brilliant. Just keep it up, and I do hope we can get you on again at a future time.
Patrick, thank you so much. I'm also a fan of yours, and I've watched many of your interviews. So thank you very much for having me, and I look forward to talking to you in the future.
That was Otavio Costa from Crescat Capital. For more of his insights on the global economy, please visit www.crescat.net. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.